you need to make a major purchase,
Mm-hmm.
the majority of people who need to make that major purchase are not necessarily going to have the cash on hand.
Taking a loan from the insurance company, they're collateralizing the cash value to do that.
So you're leveraging, in essence, this asset that you hold to go do other things that may build wealth while still building wealth with the cash in the life insurance policy.
We're here to talk about life insurance because that's what everybody wants to talk about.
We are. We're here specifically to talk about infinite banking.
Well, yeah. I mean, I was going to say, in terms of talking about cash value life insurance or whole life insurance, there's no topic that's more popular than infinite banking.
There isn't.
We know this through our own evidence, I guess you could say, of many messages from many people over the past, how long we've been doing this thing? 11 years, 11 and a half years.
Long time.
Asking us about infinite banking or mentioning it in the context of the life insurance policy they have or one they're thinking about buying.
Yep.
So
it's come up a time or 25 times.
And we've talked about it a time or 25. Yeah. But it's worth a revisit. We're getting more questions again. I think the popularity of things comes and goes. New people are always finding out about the idea, and they're questioning whether it's something they should entertain or not. And so we just figured it would be appropriate.
Yep. Let's start by kind of identifying what it is.
Okay.
Because I think there are people who really have no idea. There are some people who kind of have some exposure, but there's a lot of stuff that's not quite solidified in terms of concept. So very basically, infinite banking is the idea that you can use life insurance as a mechanism to fund what you would normally go out and finance at a bank.
Right.
So if you need to make a major purchase,
mm-hmm.
the majority of people who need to make that major purchase are not necessarily going to have the cash on hand. Or if they do, they'd rather not deplete the cash on hand to make that purchase.
Right.
So this could be something like buying a house, buying a car, buying some business equipment. You could go to the bank. Banks love that for the most part, going and borrowing money from them to do it. But,
sure.
Years and years ago, a fellow by the name of Nelson Nash wrote a book pointing out that, hey, back when I sold life insurance, one of the concepts that I presented to people who were largely in the farming industry was the fact that you could buy life insurance, specifically
mm-hmm.
whole life insurance,
mm-hmm.
and once that whole life policy built cash value, you could go to the insurance company and say, hey, I would like to take a loan against my life insurance policy. And you can do that, and you can use that loan to make these major purchases instead
mm-hmm.
of going to the bank.
Right. It's much easier. It's built into the contract. There's nothing special that you have to do. There's no special set of loan paperwork. There's no collateral you have to post, any of that, because the cash value in the policy is your collateral. You're taking a loan from the insurance company. They're collateralizing the cash value to do that. So in general, it's a very short and easy process.
And there are two things that you get from this,
mm-hmm.
arguably others, but two major things that, one, we've always been very okay with. The other one, we've had a little bit of a contentious relationship with over the years. So first, it's the fact that when you take cash, well, you don't take cash out. When you borrow against a life insurance policy,
yep.
the cash that you've actually received does not come out of your policy. It's a loan issued to you by the insurance company.
Right.
Your cash remains in the policy. It continues to grow, continues to earn the guaranteed interest that is owed on any whole life policy, and it continues to earn a dividend in most cases. There's some variation in terms of what specifically happens to the dividend depending on the type of product and the company and their practice of what we call dividend recognition, which is a little bit more complex subject that we don't really need to get into today because we want to keep things more basic about infinite banking. But you will continue to earn a dividend. So you basically get access to your money to go do other things with it
mm-hmm.
while still benefiting from the growth of your money. So you're leveraging, in essence, this asset that you hold to go do other things that may build wealth while still building wealth with the cash in the life insurance policy.
Right.
Some of the more creative marketers like to use the analogy of taking the car out of the garage for a drive around town and then putting it back when you're done. So that very true concept of whole life insurance and a key component to infinite banking.
Right.
The second component, the second piece, is in its best and most honest terms, looks something like a new motivation to not cheat the bank, so to speak. So when it's your money, you will potentially have a greater motivation to make your loan payments.
Right.
Which I have no problem with. Where things started to get a little fuzzy was this concept that you would pay yourself additional interest back to your infinite banking loan, and that was somehow going to put you in a better place.
Right. So let's break that down for a second. So as I remember reading, and the original book that Nash wrote was called Be Your Own Banker. Am I getting that right? Or Become Your Own Banker. Always forget. I can see the cover in my mind, but for whatever reason,
it's got the vault. With
yeah.
I think it's Becoming Your Own Banker.
I think it is too. So the original concept, so infinite banking was born out of that. Now, infinite banking on its own is just a marketing name. We probably should have started that by saying, like, it doesn't exist. If you go to an insurance company and say, I'd like to buy one of them infinite banking policies, they're going to pretend like you're not speaking the same language. So, but the original idea to get back to Brandon's point of the loan was that you take the loan, and let's say the insurance company has a prevailing loan interest rate of 5%. I'm just picking something random. So your loan will accrue interest at 5%. Yep. Now, what the suggestion is whatever loan you take, you design your own amortization schedule, which obviously with the internet, it's a very easy thing to do. You can find lots of free amortization calculators. And you decide, well, I'm going to pay this off over 3 years, 4 years, 5 years, whatever. And if the insurance company is charging me 5, I'm going to pay it back at 7. So the idea was that you pick some positive spread above what you're being charged to repay yourself. Because the insinuation was, who cares if you're paying 7% interest? It's all going back to you because it's your money, right? So all that money's going back into the policy. That was the basic premise, which conceptually, let me rephrase that. Mathematically sounds fantastic, right? Well, I don't care about paying more interest than what I'm being charged because I get all the money back. It's all mine. Though that's a little problematic.
Yeah. So a couple things. One, you don't get all the money back.
Right.
The claim was when you pay interest, it's returned to you as a dividend. And a lot of people people bought these policies and they took a loan, they paid the interest, they looked at their dividend, and they would call their agent and say, hey, where do I reconcile the dividend that represents the interest that I paid over the past year?
Right.
And they go, well, see, the interest coming or back to you is kind of an allusion to the fact that the interest that you pay is profit to the insurance company, which does go towards the dividend in some way somehow. So in a roundabout way, yeah, that helps them pay the dividend to you, but there's not a dollar earned by the insurance company interest that will be a dollar paid back to you in dividends per se.
And for those who are watching this or listening to this and are much more educated on the topic, I know they're thinking, well, that's ridiculous. Of course, that's how it works, and I can't believe anyone would think they'd get all their money back. I mean, and I'm not making light of this. We've had dozens of conversations with people who actually thought it worked that way. So,
yeah, well, they were told it worked that way.
Yes, exactly. So that's why we're taking some time to talk about that. It's not a direct dollar for dollar thing. It doesn't mean that infinite banking doesn't work conceptually. By the way, we're just trying to give you an honest take on it.
Right. The next component to this, which was the worst of them all, was the idea that the paying yourself 7% instead of 5%.
Mm-hmm.
That difference. So let's say that you calculated a loan repayment over whatever many years you wanted, and at 5% you should be paying $500 a month. At 7% you should be paying $650.
Mm-hmm.
So that $150 difference, that was not necessarily a payment that you made to principal of
Right.
the loan balance.
Right.
It was paid up additions that you paid to your policy on top of your loan repayment, or in
Right.
addition to your loan repayment.
Right. Through the paid up additions rider. Yeah.
So the magic that unfolded with this, the sort of sleight of hand, was the fact that you took a loan and you made these payments, and all of a sudden it looked like you had more cash value by virtue of taking the loan.
Mm-hmm. Mm-hmm.
And for the sort of those who weren't really paying close attention, there was magic unfolding at this point.
Right.
The agent would show this scenario unfolding, and it's like, this is really how it works. You take the loan, you pay $650 instead of $500. Your loan balance goes down, and it will eventually go away, but you also end up with more money.
And the thing you wanted to buy, you
yeah,
got it. So.
This looks amazing, and
Right.
this was kind of the core principle behind Pamela Yellen's "Spend and Grow Wealthy" concept inside her. What was it called? Now I can't remember.
Bank
her
on
iteration
yourself.
of the bank on yourself. There
Yeah.
we go. So this, which was just an iteration, kind of a knockoff of Nelson Nash's concepts. So the magic was there on paper, but in truth, all you were doing was putting additional money in the policy. We pointed out 10 years ago, you could have simply skipped the loan, made that $150 payment to paid up additions, and ended up with the same result.
Right. Turns out when you put more money in a policy, you have more money in your policy.
Right.
It doesn't really matter how you do it. That's the thing. One of the other this can go down into a very deep rabbit hole, and we're not going to go there. But another thing I wanted to mention, one of the fundamental flaws that or problems that we've seen with it, as well as that if you design this is particular to whole life insurance specifically. If you design a whole life insurance policy to be as efficient as it possibly can be, that is, given the amount of death benefit to the amount of annual premium paid. So we're paying a premium and we're determining what the minimum amount of death benefit that we could purchase would be based on keeping it within modified endowment contract limits and this and that and the other. So we're walking that up to the line, those ratios. If you're doing that, you will not be able to put extra money into the policy.
No.
If you're funding it exactly as planned, you're going to get into a situation where you take a loan, you can't pay back a whole bunch of extra interest to yourself because there's not enough room in the policy to do that. Now, I know what automatically that makes people think, well, why don't you just set the policy up so you have room to do that, which can absolutely be done. The problem is if you don't ever take a loan and you don't, then you're not maximizing the efficiency of the policy, so you're hurting yourself long term.
I would argue even if you do take a loan, you're still not maximizing the efficiency of the policy.
Right.
Because for the most part, you're not making payments that
Right.
are at the limit that you can.
And we're not talking about people who are buying a policy because they need a specific death benefit for,
Right.
Estate tax purposes or business succession purposes or inheritance or charitable. Those are all completely legitimate reasons to buy life insurance. That's not what we're talking about at this very moment, though.
Mm-hmm. Mm-hmm. No. Infinite banking has nothing to do with death benefit.
Right.
It's everything to do with cash value development in a life insurance policy.
Mm-hmm.
So, yeah, none of this is to suggest that infinite banking can't be done. As we mentioned earlier, there were components to this that we're totally on board with and have been forever. The rub, and it's a big one, is this idea that you can somehow supercharge your policy by taking a loan because you're making additional interest payments, which are simply just a mechanism of continuously putting more money in the policy than you would need to. You don't
Right.
need to take a loan to do any of that.
Right.
The other area where infinite banking starts to get a little wobbly in my eyes is they've spent a lot of time kind of building this reality of economic systems.
Yeah.
And making arguments about the frailty, so to speak, of current monetary policy, and there's
fractional reserve banking in general. Yeah.
Yep. This suggestion that this is all going to blow up and whole life insurance is going to be the ship that we get on to save ourselves.
Right.
And I'm not a buyer of that logic.
I've tried. I've twisted myself into a pretzel trying to make that make any sense. But insurance companies hold money, dollar denominated dollars. Is that repetitive? In the old days, we would have named our episode that.
Yep.
So if the dollar is destroyed, then that hurts everything. So I'm not really.
If the catastrophe.
And by the way, I largely agree with many of the Austrian economic arguments against fractional reserve banking and all the problems that it causes. I mean, look around. But I don't think that having a life insurance policy protects you from that necessarily.
Right. Because ultimately, if the catastrophe that they are warning us against does unfold, life insurance companies are at risk of danger like all other institutions are.
Yeah.
And perhaps they fare a little better.
Sure.
But it's still a world where we're not going to be that worried about how much cash value is in our life insurance.
Right. Yeah, I mean, there likely be bigger problems. Yeah, that's for sure.
Okay. So I think we've spent a good 20 minutes explaining what infinite banking is. Let's give people kind of a roadmap about how you actually.
Well, actually, what we've done is we've given them 20-minute explanation of the modern iteration of infinite banking.
Yes. Let's talk about kind of the how-to.
Okay.
So that people, because
let's also talk about what the original intent was.
Well, yes, and that's
I want to give Nash credit because a lot of his ideas have been. I have to keep this safe for work.
Modified,
augmented.
So
adversely.
let's do how to, and absolutely we'll do this in the traditional sense of how it was presented. Because I think there's a lot of infinite banking practitioners who forgot to read the book.
The original book, yeah.
And the book's actually decent at core concepts. Not something I think a layperson could pick up and read and go, oh, that's exactly what's going on.
No, I mean, he doesn't tell you how to design a life insurance policy to make this work. No.
Right. So step one, you got to buy life insurance. So for some people, we're already at a little bit of a disadvantage. But step one, you got to buy life insurance.
Easier said than done.
And it can't just be any type of life insurance, by the way.
Right.
They're one of the.
If you go buy a term policy, that's probably not going to work.
and it can't just be whole life insurance. One of the missteps that commonly gets made is the belief that whole life insurance is pretty universal across companies.
Yeah.
So if State Farm sells whole life insurance and Nationwide sells whole life insurance and Mass Mutual sells whole life insurance, it all must be the same whole life insurance.
Right.
And that is absolutely incorrect.
Yeah.
So the whole life policy, first, it must be dividend paying.
Yep.
And two, it has to have mechanisms that allow you to manipulate the policy to augment its cash building capability. If those two provisions are not there, dividend paying and that manipulatability or customizability, then
it won't work.
You can't do it.
Yeah.
You can't do it. And there's a rather short list of companies that actually have that, check both those boxes.
Right.
So you got to buy life insurance.
There were a lot when he wrote the original book, though. That's the thing. Like he'll talk about, if I remember, he mentions a few specific companies in there, and at least a couple of them don't even do the thing that he was talking about anymore. So
correct. That's very correct. So you got to buy life insurance. It's got to be a specific type of life insurance, and to be a very strict purist, it's got to be whole life insurance. And then step two, you got to wait.
Right.
And that part's really hard for a lot of people.
That's the part everyone skips over, Brandon.
So there was a lot of time spent. Well, there was time spent in the book commenting on the fact that if you're going to build your own bank, you need to spend time capitalizing your bank.
Yep.
And you can't.
If I remember, he compares it to literally building your own bank. Like if you wanted to start a bank in your hometown, what would you have to do? to make that happen? Well, you would have to have there are certain capital requirements that would be imposed on you by regulators to say, if this is what you want to do in your charter, then this is the amount of money you have to have on hand to start.
All of which are going to take time.
Right.
So you don't have to.
Back in the old days, you'd go around town selling shares of your bank to try to capitalize it. So
you don't have to do any of those things with infinite banking, but you got to spend some time paying premiums to build.
You still got to capitalize the bank.
You do. So once you have cash in the policy, though, you've capitalized it. It's got some cash in it, so you have enough money to go buy the things that you need or want. Then it's simply a function of getting in touch with the insurance company, telling them that you want to take a loan against the policy.
Right.
And then waiting for the money to come over. So it's really not a complicated concept.
Right.
When it comes to the step-by-step procedure.
Sure.
Trickiest part, realistically, is making sure that you land on the right product with the right company. Which that's what people like you and I are here for. That's like
our job.
We are not infinite banking practitioners, but we understand how to put this concept in place and do it very well. So there's certain elements of infinite banking that we don't always buy wholesale, but we are completely familiar with the core concepts behind it and can make it work for somebody who wants to do it. And then it's just a matter of waiting for the moment when you've got enough money to do it. And some of that comes with the mindset of, this is an asset that I'm going to build over years to have the capacity to go out and use it for this purpose. Surprisingly, there's really not much else to it than that.
Yeah, conceptually, it's not complicated. The execution of the strategy is, I think, is misunderstood.
Yes,
and especially when you see, as we have, the products that people end up with when their intention was infinite banking, and you look at their policy for them. They ask you to review it. You look at it and you go, I know what you want to do, but this policy is not going to get you there. So
yeah. Well, the original idea was very academic in many respects. Like it absolutely looked at the fact that here's something you can do with life insurance that you can't do with other assets.
Right.
And it could be very beneficial. It got morphed into, here's a way to pitch life insurance.
Yeah.
And there were a lot of agents out there who had big aspirations, or Bills do, and decided, hey, this is how I'm going to increase my production.
Yeah. Well, this boat's not going to pay for itself, Brandon.
I ain't got time for details.
Right.
But
yeah. Yes. Exactly.
So one of the questions, though, that does come up in this context, because, hey, I've got money in this special asset. I can take a loan against it, but like, are there strings attached? Like, do I have to be a certain age? Is it only for certain stuff? And the answer is no.
Right.
You can take a loan at any point. There's no age restriction on it. It's not like an IRA where you have to be 59 and a half in order to take a penalty-free withdrawal from it. And there is no, you can borrow for that, but you can't borrow for this.
Right.
Now, originally the concept was very focused on business owners.
Yes. This is the point I wanted to bring up.
Nelson Nash himself was an agent who worked primarily with people in the farming industry, where there's a lot of capital requirements for equipment.
Right.
And so...
Well, he had been a forester, right? I believe that's in his career prior to having anything to do with insurance.
Yep.
He worked in forestry.
So
yeah,
I said farming, but agriculture is
agriculture,
the more correct statement.
Sure.
So this was going around and showing people, hey, if you need a brand new $40,000 piece of equipment,
right? Which now, and that was back in the 70s. So
yes.
Nowadays, that would buy them a tire. So
instead of going to the local bank, and borrowing the money,
which these people were doing, still do all the time. It's just it's cost of doing business for them.
Yep. You could buy life insurance.
Yeah.
you could capitalize
Over
the
time.
insurance policy and then be in a position where when you need the equipment, you just take the loan against the policy.
Yeah.
Versus going to the bank.
Right.
And
then you pay
that
yourself back because you would have to make payments to the bank anyway.
That comes with theoretically reduced cost of borrowing and the fact that you have this asset that's going to continue to grow despite the fact that you've leveraged it to go buy other income-producing assets.
Yes.
So there's great leverageability there.
Yeah.
That you can capitalize on.
Right.
That got turned into, hey, you want to go on vacation and finance it with some unique thing like life insurance? You can do that.
You want to get a new car every 2 years, and
Yeah.
you can retire and take this money and build your dream house.
Which are all things you can do.
And totally fine if that's what you choose to do.
But it falls outside of what was the original sort of religion of infinite banking as put together by Nelson Nash.
Yes. Yes. I mean, the idea was that you can apply leverage to your own assets and capture a higher percentage of the return overall, as opposed to giving a big slice of it to a bank. That was the idea. And it got turned into, I think a lot of marketers and agents out there started realizing, well, the market of people there is kind of small, but the market for people who want to take a fancy vacation is huge. And people who feel like they deserve a new car every couple of years, that's
very big.
That's a very big market. So it's much easier to talk about those things and appeal to greed as opposed to, or instant gratification, as opposed to, here's a thing that can, provide all sorts of wonderful benefits to you, but it's going to take some time.
Yeah. Yeah. Okay. Drawbacks. Yeah. There's got to be a couple, right? Like, this isn't all just kittens and rainbows.
Yeah.
You do have to buy life insurance. Which means you have to be healthy enough to qualify as life insurance.
Yep.
And somewhere along the way, I don't remember who, could have been Nelson, could have been someone else, did bring up the idea that, well, if you're not personally healthy, you may just go somewhere else. Like, maybe you're married and your spouse is perfectly healthy.
Mm-hmm.
Or maybe you got kids.
Right.
And you just buy policies on them.
Or better yet, grandkids.
I don't know.
They're really young.
So that is very easy to say, and that's about it.
Yeah. It's not easy to do in practice.
No, it's not.
Ask us how we know.
It is definitely something that you personally kind of have to have health to the degree that you can.
Or spouse.
For life insurance.
I mean, the spousal thing does work. The problem with kids, we've talked about this before, but the problem with kids or younger people is that the same amount, let's say you wanted to put $20,000 a year into a policy. Mm-hmm. The problem is if you do that on an 8-year-old, it's going to buy like $8 million worth of life insurance death benefit. Even if we design it and squish it down as low as we can for that premium, and there's no insurance company in the world that's going to give you an $8 million death benefit on an 8-year-old.
Not unless your kid is the star of a brand new sitcom that's going to...
If he was in Home Alone, the original.
Yeah.
Not 3. Yeah. I mean, there's just very few. I mean, there are circumstances, obviously, where they would, probably. But generally speaking, most of them hit their gag limit at $1 million. Mm-hmm. There are a lot of questions asked about that. So it doesn't work.
Yep. You also, I mean, really seriously, we mentioned it. I'm gonna kind of really beat the dead horse on this. You gotta be willing to wait.
Yeah.
I can't tell you the number of times people have called us looking to start an infinite banking policy and will tell me something like, I got an investment opportunity that I want to get going on. I'm going to need $100,000 for it.
Yeah.
So, like...
How quickly?
Yeah.
Can I have $100,000 to borrow from my policy?
If you're planning on putting a $200,000 per year premium into a policy for the next several years, we could probably make that work.
Yeah.
I don't really know why we would. I think you'd be better off just taking $100,000 and pursuing that investment opportunity.
Right.
But it's not something that we can start if you've got something going on right now.
Right. Yeah.
You just got to understand you're going to miss that one and then capitalize and catch the next one.
Yeah.
Hopefully.
Right.
The next one.
Right.
So the other piece to bring up here, so infinite banking has commonly pretended like borrowing from the bank will always be the less good option.
Mm-hmm. Mm-hmm.
And that's not true.
Yeah, you're right about that.
There are times when net borrowing from the bank might be a better deal.
Yeah.
And there's nothing wrong with that. That doesn't make infinite banking unusable.
Yeah.
Things are going to shift. Right now, it's almost surely the case that infinite banking would be the lower cost option.
Right. But 3-4 years ago, not the case necessarily.
Now, something that confuses people is nominal interest rates do not function the same in terms of net actual cost.
Mm-hmm.
So interest rate at a bank is not the same as interest rate on a life insurance loan.
Mm.
The way that interest accumulates on those loans differs.
Yes.
And so when you compare the nominal loan rate of the bank's offering versus what you could get with a life insurance policy, there is going to be a difference in terms of net cost.
Mm-hmm.
And general rule of thumb is you can get somewhere around a point to maybe 1.5 spread in favor of life insurance. So if you've got a 4.5% rate
mm-hmm.
at the bank,
mm-hmm.
something closer to 5.5, 6 is probably going to be very similar in net cost with life insurance,
right,
as it would be the bank. So that's a tricky concept for people, and it throws them a lot, but it is true.
Right.
So even in times when interest rates are relatively low and banks look attractive, we've got to actually run the entire scenario out. We've got to figure out what is the actual payment going to be, what is the cost of borrowing, the entirety of the accumulation of interest on this loan if you carry it to term, because they do collect interest differently.
Right. Right. Okay. Last point that I wanted to bring up. And again, this could probably go off on its own. Maybe we'll do a future episode and talk about this. There's a big insinuation. It's probably more than insinuation. It's in black and white, and it's written all over the place by many practitioners of infinite banking that dividend-paying whole life insurance is the only product that infinite banking works with. Mm-hmm. You cannot use universal life insurance, all types. It's evil and terrible, and you will rue the day that you bought this. So let's give that 2 minutes.
You want to know what the most confusing thing about that is to me?
What's that?
So there are a number of people inside.
I mean, other than that part.
There are a number of people inside the infinite banking world who build a very strong case for the superiority of life insurance companies.
Yes.
And it's almost as if those institutions can do no wrong,
mm-hmm.
and everybody else has it incorrect.
Right.
And yet somehow we have to put the additional modifier that there's a special form of life insurance companies that got it right. Everybody else in the life insurance industry is they're in the same boat as all those fools over at the Fed.
Right.
So it's almost like I'm listening to a Robert Tilton episode. There's just 3 companies out there listening to me right now who could do it. It's like, come on, guys. You're gonna try and convince me that the world being as big as it is,
mm-hmm.
the sheer volume of life insurance policies sold that are not whole life insurance and sold for similar reasons to infinite banking.
Right.
There's just this hundreds of thousands of people being led to slaughter.
Right.
Where's the blood in the streets?
Right.
You can absolutely use universal life insurance to employ most of the concepts of infinite banking, the ones that matter.
Right.
Now, it is a true statement that with universal life insurance, there is not a practice of collecting profits and tying those to a dividend payment to policyholders, universal life insurance policies for the most part do not earn dividends.
Right.
So, that part's not there. But you can still leverage a universal life policy. You
Yeah.
can take a loan against a universal life insurance policy. You can still earn interest on a universal life insurance policy, and you can do things that are whatever you want with the money that you took the loan for with the universal life insurance policy.
We have clients that use index universal life insurance in this context.
Mm-hmm.
So, I mean, you can say it won't work and it can be done, and I'll just say, well, they're doing it, so
You're right. This person's sheer existence
right.
casts serious doubt on your expertise
Right.
in this subject.
Well, and the problem is the criticisms are unfounded. So, and we've talked about that, and we will. We'll just do a whole thing about that at some point in the future, maybe.
Yeah.
You like that? We'll do that, maybe.
We'll do that at some point, perhaps.
Exactly.
If you hear this and you think that'd be a good subject and months go by and you haven't heard it, reach out, because we've probably forgotten that we said we would do that. It's always good to be
possible.
reminded.
It's always possible.
Always good to be reminded.
All right.
Yeah, that's basically it for today, I think.
Yeah. So I interrupted you.
No, go right ahead.
We're such pros at this. Yeah, thanks for joining us. If you'd like to get in touch with us, you'll find a link down in the description below. You can visit theinsuranceproblog.com. There's a link to our contact page there, which is the easiest way to get in touch with us. Just send us an email. Let us know what's on your mind. We'll see you next week.